We know what works during bull markets. We know what works during uptrends. And if it's my job as an investor, and it is to make money as an investor, then I want to do everything that I possibly can to exploit bull market conditions while they're intact. So what does that actually mean in terms of allocation?
The US and China are set for a trade war showdown. The federal government has been shut down for 20 days, and the market is pulling back amid rising uncertainty. Hello and welcome to Milk Road Macro, the podcast that knows that technical analysis is just astrology for finance bros, but sometimes you still just got to look at a few charts. I'm your host, John Gillen. Today is Monday, October 20th, and we are joined by the Chartmaster Wonder Kid himself, Caleb Franzen. Caleb is a financial analyst and the founder of Cubic Analytics, where he provides in-depth research on macroeconomic trends, the stock market, and Bitcoin. Caleb quit his corporate job to launch his own independent research on X and Substack, and he has become something of a legend since then. Caleb has brought tons of alpha exclusively to share with the viewers of Milk Road Macro. So if that sounds good to you, make sure you like and subscribe. Share this episode with someone who needs to see it, because God knows we all need some help right now. And without further ado, welcome back to Milk Road Macro, Caleb Franzen. How are you, sir?
My man, good to see you, bro. Been looking forward to this.
Yeah, me too. Sometimes you just got to look at a few charts. Like I said, I think a lot of people have been getting uncertain. We spoke last time, I think a little bit over a month ago. You were very bullish then, but now some people are saying that we've flipped into a bear market. There's been a pullback in stocks and Bitcoin and gold. Where are you on all of this? Have we flipped into a bear market, or are we still holding bull market support? How are you looking at the markets right now?
Yeah, look, I feel a little bit personally attacked, by the way. Coming in here, you're talking about charts or astrology for men. You got to know your audience here. No, I'm kidding. But in all seriousness, this market, in my opinion, has still been on fire. I know if we're thinking specifically about what's taking place in Bitcoin, what's taking place in crypto, largest liquidation events in crypto history, at least on a market cap basis, that was not a lot of fun, or in some ways it kind of was. But I mean, let's really kind of contextualize what's actually taking place here. Since we recorded that podcast the last time that I was on in earlier mid-September, we've seen great things continue to take place. First of all, not only did Bitcoin go from 108,000 to 126,000, but we've seen continuous new all-time highs even in the equity market. So if we start first and foremost just looking at the NASDAQ 100 here, by the way, the NASDAQ 100 last week had its highest weekly close of all time. And today it's on track for its highest daily close ever. That's in an environment, by the way, where the Russell 2000 is making new all-time highs, microcaps IWC is making new all-time highs. And then we could break it down a step further. If we look at industrial stocks, which have the highest correlation out of any sector in the market versus the S&P 500, this looks fantastic to me. Of course, it's kind of been flagging up here for the past few months, but no harm, no foul. This looks great. If we look at semiconductors, which have without question, been the leader during this bull market, these are making new all-time highs today, up 2% when I took this screenshot less than an hour ago. And then let's look at some of these intermarket relationships. We have growth relative to value stocks making new all-time highs. And we also have high beta relative to low volatility making new all-time highs. So as far as I'm concerned, it's very important for investors to remember and recognize uptrends are just the sustained production of higher highs and higher lows. We need to give the market the freedom and the opportunity to produce higher lows. And so, of course, in my opinion, that's what's taking place with Bitcoin right now. But as we look at the equity markets, they're in process, literally as we speak, of producing higher highs. So as far as I'm concerned, we still have very clear-cut uptrend confirmation across the board.
Great. So I think, you just went through a lot of charts really quickly there without drilling down on all of them. Maybe just unpack this one here for us. What does high beta versus low volatility mean? And what is that telling investors if that chart is making new all-time highs?
Yeah, this is one of my favorite charts because as we think about high beta stocks, what does that mean? It means high beta relative to the S&P 500. So if the S&P 500 is up 1%, high beta stocks are going to be up maybe 2%. If the S&P 500 is down 2%, high beta stocks might be down 3%, right? So they're going to have these larger moves relative to the rest of the market. Whereas low volatility is exactly what it sounds like. These are going to be much more defensive in nature, much more of like consumer staples stocks, very, much less cyclical. And so when we're looking at this chart, high beta relative to low volatility, when this chart is going up and to the right or producing higher highs and higher lows, that's telling us that we are in a market environment with very strong risk appetite. Risk on is outperforming risk off. That doesn't tend to happen during downtrends. That doesn't tend to happen during bear markets. On the contrary, it exclusively happens during uptrends and bull markets. So as we're looking to kind of basically confirm or deny the weight of the evidence that's taking place at the index level, for the S&P, for the NASDAQ, for the Dow, for the Russell, these kinds of intermarket relationships are really important to kind of provide some of that additional context.
Gotcha. That's really helpful insight there. And this is one of the reasons why I love having you on. You don't just do astrology on charts. You find new ways to look at the market through this analysis. This is really helpful. So this is telling us that allocators are seeking risk, not defensive allocations in the equities market right now. Really helpful insight. I wanted to ask you about another thing. You put out an article on your Substack this weekend focusing on the relative performance of small cap growth versus small cap value. And you called this the most important chart for the stock market right now. Why is this chart so important, and what is the message that this is sending to investors right now?
So this is a super, super underrated chart. Most people probably don't even know these ETFs exist, right? So this is the Russell 2000 Growth ETF, IWO, relative to the Russell 2000 Value ETF, IWN. First of all, let me just be very clear. Both of those ETFs literally right now are in the process of making all-time highs. So both of those funds are performing quite well, at least from a structural perspective. But when we look at them on a relative basis, it's providing very similar analysis to what we were doing earlier with high beta relative to low volatility. When this chart is producing higher highs and higher lows, as it has been since the middle of 2022, that's generally a confirmation of the uptrend that we're seeing at the index level for the S&P 500, for the NASDAQ, so on and so forth. But I also think there's something really important here from a macroeconomic perspective, right? I'm an economist by way of training, if you will. That's what I have my bachelor's degree in. But, charts are king, price is truth. And so for me, this is what's really important, because let's think about this. Small cap stocks, and in particular, small cap growth stocks, are going to be extremely cyclical by very nature, right? So when we're looking at the small cap universe and we're saying, hey, how are those small cap growth stocks performing relative to the value universe? When this chart is going up and to the right, that's basically additional confirmation that we're in a relatively strong or robust macroeconomic backdrop, because investors would not be bidding small cap growth stocks relative to small cap value if they were pessimistic about the future. Look at when this chart peaked, by the way. It was the end of 2021 going into 2022, and then it had this massive drawdown and bear market, right? Excuse me, I misspoke. The end of 2020 going into 2021. By the way, early 2021 is when the ARK universe peaked. That's when a lot of the speculation, the SPACs really peaked out, right? So this chart is really, really important. And so as we're looking at this right now, making higher highs and higher lows, trading at the highest levels since Q4 of 2021, this is not insignificant. And by the way, let's also contextualize this with this chart here. In the lower pane, I've just added on TIP, which is a Treasury Inflation Protected Securities ETF. This is so important because if we think about economics from a Keynesian perspective, where growth and inflation are positively correlated, when we look at this ratio here of IWO relative to IWN in the top, and then Treasury Inflation Protected Securities in the bottom, we're getting a lot of there's a lot of consistency between these two charts. They look almost identical. And that's because the market is pricing in higher inflation as well, right? So not only are we seeing higher growth expectations, but those higher growth expectations are coming at the cost, if you will, of higher prices and higher inflation. So not only is this IWO versus IWN chart so significant for markets, it's also extremely significant from a macroeconomic perspective as well.
Okay, very helpful. So what you're saying is that the long-term trend that we've been in for several years is still holding, and that inflation expectations and continued growth is still what the market is forecasting. Is there a indicator that you are looking for, a single indicator or a confluence of indicators that you're looking for to be able to say when the market might have topped and flipped bearish? Because I think a lot of people are trying to figure out when we've hit that point. And what would you have to see to change your mind to say that this bull run's over, we flip bearish? How are you thinking about that question?
Perfect. So for me, it really comes down here to credit spreads. And so this is just the U.S. corporate index option adjusted spread. What we're looking at here is corporate bond yields relative to treasury yields, basically on the same duration. And so one of the reasons I think for me why I've been able to stay so calm during this pullback, I was on another show about 2 or 3 weeks ago before the whole China tariff stuff came back into the picture again. And I referenced the next chart that I'm about to show you, but let me just preface this very quickly, is what I'm about to do is just invert this chart of credit spreads, and then I'm going to overlay the S&P 500 in the bottom pane. And that's what we're looking at right here. And so historically, what we tend to see is that very bad things happen in the market when there's a divergence taking place between corporate spreads and the S&P 500. So if we look down here, when the S&P 500 was making higher highs and corporate spreads were diverging, same thing was taking place at the end of 2021. Same thing was taking place in Q1 of this year. bad things tend to happen, right? We obviously experienced a very significant drawdown at the beginning of this year. 2022 was a terrible year, and then we obviously had COVID. So as far as I'm concerned, this chart has basically forecasted the three biggest drawdowns that we've endured over the last 5 years, and I think that's really significant. The thing that gave me a lot of confidence in this market environment is the fact that we did not have that divergence in this current environment. Right. So again, it goes back to kind of what I was saying earlier, which is that uptrends, which we're in one right now, have pullbacks. Those are completely normal. There's a kind of this funny phrase that I've been repeating, which is that if you don't love a bull market at the opportunity to produce a higher low, you don't deserve it when it's producing a higher high. Right. And I think that's really, it's such a cliche statement, right? But it is really important. So we have to give this market the opportunity to produce a higher low so that we can enjoy the higher highs. And in fact, we should actually be allocating into that potential production of a higher low, at least as far as I'm concerned, because we're not seeing these bearish divergences taking place.
I don't think that catchphrase is going to catch on, but I like it a lot. So yeah, I appreciate the perspective on that. So you brought up the S&P 500. A lot of analysts have been calling for the S&P at 7,000 by the end of this year, by early next year. Do you see that happening? What is your forecast for the path of the S&P from here? Just like, directionally higher, or is there a specific target that you're looking for? Like, what are your thoughts on that?
So I don't have a target for the S&P 500. I think one of the things that I've learned as an investor over the last 12 years is trying to call a top, especially during a bull market, is a fool's errand, right? And so all I know for a fact is that we're in a bull market, we're in an uptrend. So why try to cut the party short? You know what I mean? And so if we're in this uptrend, and we are, then let's just do whatever we can as investors who are focused on making money to align with that uptrend as much as we possibly can, instead of trying to forecast when it's going to peak out. And so in a market environment where forward 12-month earnings for the S&P 500 continue to make new all-time highs, we have interest rates modestly coming back down. This is an environment where we still want to be net long. We might want to, cut the weeds and water the flowers in terms of portfolio management here. But as far as I'm concerned, this is still, for me, an environment where I want to be adding to core portfolio holdings. This is where I want to continue to be net long, so on and so forth. And that's basically what I continue to do, at least.
Gotcha. Yeah, very helpful perspective. I like the metaphor of leaving the party early. When I was working at BlackRock, I had a rule: I would always leave any corporate parties at 10 p.m. But that's not what you want to do in a bull run. So that's really helpful. I want to talk a little bit about some of the flash crash and the trade war, Trump's tweets. You talked about crypto. But let's start with the S&P 500. A lot of people are blaming the pullback we saw on Trump's tweet. We saw the S&P 500 dip pretty hard following that. And for those who don't know, it was a tweet about escalating the trade war with China, and putting 100% additional tariffs on them, and that kind of kicked off a lot of things. But the dip in the S&P wiped out, I think, $1.6 trillion of market cap before it started to bounce. Do you think that this has shaken investor confidence? Do you think there are lingering concerns from this, or has the market mostly digested this and moved on? Like, where are we right now in that?
I hope it's shaken investor confidence, because I've been buying, right? So I need somebody to buy those shares back for me in 3 to 6 months or a year, right? So I think, of course, it's shaken investor confidence, because when you're dealing with something as unpredictable as what is Trump going to tweet today, we can't predict that, right? And so it's not my job to try to forecast that. I'm certainly not a political strategist, and even if I was, I'd probably be a terrible investor. And so as far as I'm concerned, I just want to be focused on price. I want to be focused on these intermarket relationships. I want to be focused on statistical indicators, because if you ask 100 people, what is the risk of Trump tweeting anything that's going to be a risk to the market, you're going to get 100 different answers and 100 different magnitudes of those risks and timing, right? And so I have no edge there. And so if those things do come to fruition, then I can just rely on the technical analysis. And so for me, when I'm looking at a pure retest of the 21-day EMA for the S&P 500, when I'm seeing weakness under the hood in terms of the S&P 500, looking at RSP, which is the equal weight version of the index, for me is an environment where I'm saying, hey, some of these stocks that I've liked that maybe I haven't owned, I want to start building a position in, right? So I've been able to add to some semiconductors. I've been able to add to some of these cybersecurity stocks, which I already own a lot of anyways. But I'm saying, hey, some of these are down, 20%. It would be almost foolish of me not to be taking advantage of some of this volatility.
Gotcha. I think that's a helpful way to think about this. I would like to hear some of your thoughts on this, though, because no one, like you said, can forecast Trump's tweets, but he does move the markets a lot when he does that. How do you think about this new idiosyncratic risk as an investor? Is it, like you said, this is just like you ignore it completely? Do you try to take advantage of it? Do you just wait till the noise blows over? Because I think a lot of people now are starting to be like, okay, this might be something that happens every couple of months where he tweets and several $1 trillion of capital move. How do you think about that? Is that something investors need to pay attention to or just completely ignore? Like, what are your thoughts on that?
So let's suppose you're right, and he does do things like this every few months. Like we're 6 months down the line, 3 months down the line, more things are happening like this. This is where, the power of technical analysis, having a plan, is going to be really impactful, because again, we can't predict when those things are going to happen, but we know exactly what bull markets look like. We know exactly how they behave. We know what uptrends do. And so if we just quantify that and reverse engineer it and say, hey, during uptrends, when are statistically favorable times to be adding the risk assets? Then regardless of what the headline risks are, we should be probably allocating some money into that environment. I'm not saying go all in. And this is also a super healthy reminder here to not be touching leverage, to not be, for me personally, I don't trade any options, right? Because, I was able to sit through some of that volatility, 2 Fridays ago, and I was actually having a hell of a lot of fun. I've been looking at the market for the past several months. I'm saying, look, I've been bullish, I've been optimistic because we've been in a bull market. By the very definition of that recognition, I'm expecting to make new all-time highs. So as we continue to make new all-time highs, I'm bored as hell. Nothing new is taking place. So it's actually the contrary. When we see some of that volatility come into the market, when we see things go haywire, and we see a lot of investors run around like chickens with their head cut off, that's where I start to perk up. That's where I sit up in my chair. I say, hey, now I actually have a chance to go out and make some money in this market and take advantage of everyone else's laziness and fear and use that to my advantage.
Interesting perspective. Yeah, I think it's in every crisis there's an opportunity, and so looking for the opportunity in the crisis is good advice in general. I do want to shift now a little bit to some of the other markets that were impacted by this tweet and the circumstances around it. The crypto market saw its largest single day market event in history, nearly $20 billion in liquidations. Some estimates are actually higher than that. In one day, there's been lawsuits, accusations, CoffeeZilla is doing an investigation. But setting aside all of that, of like what happened in the markets, how are you seeing Bitcoin and the broader crypto markets digesting this? Is this like really broken the market there? Is there still strength? Like, what are you looking at in the crypto markets and the impact coming off of this huge market event?
So let's think about it, right? We did have the largest liquidation event in crypto history from a market cap perspective. And this morning, Bitcoin's trading at 111,000. Just let that simmer for a second, right? So, I think this is really important. I'm being serious. And so what's going to be a challenge for a lot of investors, and thankfully it isn't for me, but we need to get comfortable dealing with large numbers here, right? And the reason why I'm saying I'm able to deal with that is because I like to just measure things in terms of percentage moves, not in terms of dollar moves, right? And so when we're seeing Bitcoin fall from 126,000 to 103,000 in basically a week, a lot of people get really scared. Oh shit, we just fell $23,000. Bitcoin wasn't even trading at 20,000 in 2017, right? So for a lot of people, that's a really material swing. But the reality is it was an 18% pullback. And I know that doesn't feel great. And I know firsthand because I have 80% of my liquid net worth invested in Bitcoin, right? So I just have to embrace that. We need to know what kind of asset we own here, guys. And so I think that's really key, because if we look at historical bull markets, it's extremely common to see 20 to 40% declines before producing another higher high, right? So I think that's really critical here. And again, it's just a really healthy reminder where, for me, I didn't have basically any altcoin allocation going into that environment, certainly didn't have any leverage. And I'm able to look at everyone else running around like a chicken with their head cut off and saying, hey, cool, I'm going to buy Bitcoin at 108,000. Hey, cool, I'm going to buy more at 108.2. Hey, cool, I'm going to buy more at 105.3. And that's exactly what I've done, right? So these have been 3 big purchases that I've been able to make now. And I'm certainly not taking any victory laps with us trading here at 111,000, but I want to be super clear. Like, my expectation is we're going to make new all-time highs. If you want to go to the chart that I brought with me here on Bitcoin's 30 and 60-day volatility, we were trading at multi-year lows in 30 and 60-day volatility for Bitcoin. We finally had that kind of hiccup environment to bring that volatility into the market, to get some of that capitulation dynamic. And I want to just ask, right? Like, we've obviously seen a pickup in market volatility for the CBOE S&P 500, the VIX. But also if we look at the MOVE index, bond market volatility, both of those are starting to recompress back to the downside, and they were just at cycle lows. So from that perspective, like, I think it's really important for us to ask, if Bitcoin's volatility on a 30 and 60-day basis goes back in the downtrend that it's been in for several years, what's happening to the price of Bitcoin? It's probably making new all-time highs, right? And so that's still my expectation. My 175K minimum cycle target is still intact. It hasn't been invalidated yet. And so this is business as usual as far as I'm concerned.
Gotcha. Yeah, a helpful perspective on all of that. And I think that the cycle target of 175K is something I've still had in the back of my mind since the last time we talked. So I'm glad that hasn't shaken you off of that. I do have a question about this, though, because a lot of investors are getting a little bit nervous about this drop in volatility and, like, let's say, lagging performance from Bitcoin. Historically, Bitcoin will usually follow gold and global liquidity higher. So like measures like M2, which we talked about last time, whenever they move higher, Bitcoin follows, but on a lag. But Bitcoin, it seems, has been lagging very far behind gold and M2 recently. Do you think that this is, like, do you agree with that perspective? Do you expect Bitcoin to catch up in like a rapid move to the upside? Like, what are your thoughts on this, and where do you see Bitcoin going from here?
So I do think in a lot of ways that gold is going to need to cool off and consolidate, very similar to what happened in April through July of this year, in order for most risk assets, whether we're talking about equities and Bitcoin, to really bid back higher with a lot of strength. But I do want to push back here, because if we look at Bitcoin's market cap relative to the US dollar adjusted M2 of the US, Japan, Canada, the EU, and the UK. This is what I consider to be global M2, just mostly because I don't really trust a lot of the data coming out of both China and India. So for me, this is my gauge of global M2. And it's hard for me to say that Bitcoin is lagging M2 right now, right? And in fact, we've basically seen M2 consolidate for the last several months, or trend sideways here. And that's exactly what Bitcoin has done as well, right? If we're just looking at this on a monthly perspective. So I'm not seeing anything overly concerning here, because if we look at what's actually taking place in the United States, first of all, M2 itself is at new all-time highs. But if we look at M2 growth measured on a year-over-year basis, it's growing at 4.8% year over year, and it's been accelerating now for years, right? For at least 24 months. So, this growth here in M2 is definitely encouraging in terms of putting a relentless bid under financial assets and dollar-denominated assets. We can also look at loans and leases and bank credit. Is that money leaving the financial system and entering the real economy? The answer is yes. Loans and leases and bank credit are growing at 4.9% year over year, a very healthy metric. If we look at the adjusted National Financial Conditions Index, this is tracked by the Chicago Fed, this is making new multi-year lows. So again, this is a net positive for liquidity dynamics. And again, this just brings us back here to this main chart here, right? So maybe some things are happening in Japan and Canada and the EU and the UK. I don't really track what's taking place M2 wise on an individual basis for each of those countries. But as I'm focused just specifically on what's taking place in the US, to me, it's pretty darn clear that there's still an upside bias at least taking place for Bitcoin and risk assets in general.
Gotcha. I think that this is something that a lot of people who are analysts in digital assets talk about, but I think that your adjusted view of M2 is interesting, and the chart kind of speaks for itself. It does seem to be a bit more tightly correlated, so maybe there's some validity to that analysis. I want to go back to the financial conditions chart
Sure.
and just ask you to explain that a little bit more to our audience, because I think that this is something that people in macroeconomic circles talk about a lot, like financial conditions, but I think a lot of people don't really understand what this index is telling us, what goes into it, and why is it important that it's making a new low?
You know what's funny? I don't even know what goes into it. And to be honest, I don't really care to know what goes into this. All I care about is the direction, right? And so as we're looking at this chart, it peaked in the middle of 2022 when inflation was peaking. This has provided a lot of really interesting macroeconomic context and affirmation for the uptrend that we've been experiencing in risk assets now for years. And so for me, all I care about is the direction here. Are we seeing a divergence take very similar to that credit spreads chart that we were looking at earlier, right? And so, I'll track some of these individual metrics, like what are banks actually doing? Are they extending their balance sheet? I used to work at a bank for several years, helping to manage a very sizable commercial loan book. So I'm really familiar with these kinds of numbers and what this means. And so as we're thinking about the National Financial Conditions Index, again, this is tracked by the Chicago Fed, and I'm taking it a step beyond, because what we're doing here is we're actually looking at the adjusted National Financial Conditions Index. So what even goes into the NFCI? I don't know. What's the adjustment? I really don't know. So all I care about here is the direction.
Right, but the trend has been very clear for the last several years, and that hasn't broken yet. And I think that's, look, that's a good takeaway in and of itself. Okay, look, I think we talked a little bit about some of the recent market uncertainty. We talked about how the larger overall trends are still intact. Have you been deploying capital into this environment on this pullback? Are you still waiting for any specific point to be sure about, moving in with more size? How are you thinking about allocating your capital in this circumstance that we're in right now?
So I've been buying Bitcoin with size, I would say, at least for me. But again, that's just kind of where I'm at, right? Because I'm looking at this divergence taking place between equities and Bitcoin, and even in terms of what's taking place with gold and Bitcoin. And I'm expecting to see Bitcoin catch up both on an absolute and relative basis and continue to trend towards my 175K cycle price target. So I think that's really important. Regarding my kind of TradFi exposure, this year, more so than anything else, has largely been about just sitting on my hands. I took a tremendous amount of risk in 2022, 23, and 2024. And so this is something I talk about quite a bit, actually. It's the risk of not investing. When it feels like the world is about to come to an end, look, we're young, so we need to be investors. We need to accumulate assets, and particularly core portfolio holdings that we have really strong conviction in over the long run. And so when you're doing that during unfavorable times, and then sequence of return risk works in your favor, i.e. the market continues to go up, that gives us a lot of freedom and flexibility to, first of all, not succumb to FOMO and also not to succumb to greed or just outright fear. When I'm seeing some stocks I own like Cloudflare, I think I'm up like 190% on my Cloudflare position, which I started like less than 2 years ago. So, I'm willing to let that stock fall 30% and not get shaken out of the position. And in fact, that would just be for me an opportunity to buy more. And so in terms of the equity markets, right now, I have been buying some things. I've been buying some Amazon. I've been buying some semiconductor stocks. I've been buying some other software and cybersecurity stocks. That's where the bulk of my net worth in the equity portfolio is allocated, is into those sectors and themes, in addition to just mega cap growth in general, right? And so, yeah, this has unequivocally been an environment for me to be allocating into. But as far as I'm concerned, right, it's been much more of a concentration in Bitcoin than anything else.
Gotcha. I really appreciate the transparency on that, of like saying exactly where you're looking and where you're putting your economic energy and capital, because I think that a lot of people have been wondering, is this dip still one to buy or not? So that the confidence there is encouraging.
Can I say one more thing on that really quick?
Sure, absolutely, yeah.
I said this earlier, but we know what works during bull markets. We know what works during uptrends. And if it's my job as an investor, and it is, to make money as an investor, then I want to do everything that I possibly can to exploit bull market conditions while they're intact. So what does that actually mean in terms of allocation? That means buying technology stocks. That means buying the Magnificent Seven. By the way, Mag 7 earnings are growing faster than the S&P 493 earnings. They're magnificent for a reason, folks. Semiconductors, new all-time highs. Cybersecurity stocks, new all-time highs, right? So this is exactly where I've been positioned, because my general thesis has been, we're in a bull market. We don't know when it's going to end, but we know exactly what works the best during a bull market. So during that environment, I'm just going to continue to allocate to those themes that work the best. It's really not rocket science, and as much as possible, I don't want to make it rocket science. I just want to take advantage of market conditions while they're intact. So sorry to cut you off, but I did want to add that point because I do think it's really important.
No, yeah, absolutely. I do think that's really helpful perspective. I got my questions a little bit out of order here, and I don't know if you have a chart on this, but I did want to ask you quickly about gold, because gold has been in a historic bull run. I think it made all-time highs last week around 4,400, pulled back pretty sharply, kind of spooked a lot of people, and then now this morning it is back up, pushing back to $4,400 an ounce. Yeah, I guess my question is on this is like, what is the message? Look, is this bullish or bearish that gold is having this much of a bull run, right? Like, is this like a sign that there's instability in the markets and people are panicking, trying to find safety? And then how high do you think gold is going? Some analysts are calling for $5,000. What are your thoughts on the gold market? What's the message this is sending investors?
I don't own any gold. I haven't owned any gold for a long time. Not since the second half of 2020, which I probably should have held on to, but I ended up buying Bitcoin with that money. So I had no harm, no foul, right? Not too bad. So look, I don't know. I think for me, I've definitely been fading the move in gold. I obviously have not been shorting it or fighting it, but I just haven't aligned with that trend, mostly just because I'm more focused on aligning with trends and risk assets. And so for me, that's where a lot of my focus has been. So I'm probably not the best person to really ask about gold. But what I will say is, at the various times where I've called for like a local market high in gold, it just keeps ripping face. So what I would say is, like gun to my head, I would probably have to be bullish on gold just because it's in such a significant uptrend. But it kind of goes back to what I was mentioning earlier. Like if you own gold and you've been able to take advantage of this move, like, are you really allocating more into this exponential trend? Because, like the last time I think this happened was back in like 2006, where we had like this kind of exponential move, right? Or at least maybe back in 2011. So, I think from that perspective, it's just, it's hard to know exactly what to do with gold here, but gun to your head, you have to be bullish just because it's a simple uptrend, right? And what I would say is, as soon as you see me buying gold, you sell as much of it as you possibly can.
Okay, well, I'll definitely use you as my top signal for gold. Yeah, look, I think the thing that's getting my attention about it is that I was expecting some kind of cool off, and it's like already pushing new all-time highs again. So I'm definitely watching gold. I think a lot of investors are. So we'll pay attention to that. I want to pivot now. We're coming towards the end of the show. I want to get your thoughts on some forward guidance here. Jerome Powell gave a speech, and he basically forecasted that despite the government shutdown and the reduction in new data coming out for the Fed, he's still anticipating a rate cut at the October meeting. He also forecasted that there would be an end to quantitative tightening. A lot of investors are saying that this is bullish. What are your thoughts on this? How big of a market catalyst could that be? Is this really important, or is it sort of just expected path for the policy from the Fed? What are your thoughts on this?
So it is bullish. One of the things that we had talked about on the first show that we did a little bit less than a month and a half ago was how these rate cuts are different, right? When we were looking at the rate cut environment in September of 2024, we had firm evidence of disinflation. That's no longer the case. That's also probably why gold is bidding, right? It goes back to that chart on tips that I was sharing earlier. It goes back to that IWO versus IWN chart. And inflation is objectively reaccelerating on a year-over-year basis. Unfortunately, we don't have the latest data, right, because of the government shutdown, but it is what it is. But in terms of monetary policy expectations, my secret weapon for years has been this chart right here. So in blue, we're looking at the 3-month treasury yield. In red, we're looking at the 6-month treasury yield. And in green, we're looking at the effective Fed funds rate. And unequivocally, when we see a breakout in yields above effective Fed funds, we go through a rate hike cycle. When we go through a pause, it's because that those yields are basically tightening up amongst each other. And then when the Fed is getting ready to cut interest rates, we see those yields break below effective Fed funds. And so as we're looking at this market dynamic taking place right now, I think I published this over the weekend, yesterday actually, so maybe it's already changed a little bit here today. But these yields are telling us that the Fed is going to cut interest rates again. So as we think about what are the implications for this upcoming meeting, the market is essentially already priced for these cuts, right?
Right.
And it's kind of a cop-out answer, but what continues to move the markets, at least on Fed policy decision day, is Jerome Powell's press conference, because the market is hinging for any sign of exactly how you started this, which is forward guidance, right? What is the Fed? How is their reaction function evolving? What kind of data are they going to be prioritizing? And I think generally speaking, we know what the answer to that is. It's labor market data. They've already been willing to stomach some of the reacceleration of inflation that we've already endured. By the way, it's been a modest reacceleration, but an acceleration nonetheless. And their priority right now seems to be much more focused on risks to the labor market. The challenge here, obviously, is that we're in a government shutdown, right? So we don't get non-farm payroll data. So I think the market is going to be heavily dependent on, look, hopefully this thing gets resolved here in the next week, maybe two, but the market's really going to hinge on the ADP private payrolls data, which has been looking much weaker in recent months, so that's going to carry a lot of weight.
Right. Yeah. And I think that this chart really spells out that the market is not only predicting this, it's already priced in cuts. So if Powell doesn't cut, I think that will be kind of a speed bump for the market and really reset a lot of expectations. But it does look like that's the direction that things are going. So appreciate the thoughts on that. I think this will probably continue. So we'll have to pay attention to Powell as he adjusts, what he's saying. But helpful insight on this. One other thing I wanted to ask about it could be a potential big market catalyst that's coming here. President Trump and President Xi are scheduled for a meeting at the end of this month in Korea. And there's been, obviously we talked about Trump's tweets and the trade war, but there's been a lot of hope, optimism that coming out of this meeting, we'll see some sort of like grand bargain between China and the US and get some certainty and clarity around that. And that trade war will end, at least for the moment. And that could be a big bullish market catalyst. Is that something that you're watching closely? Do you expect this to pan out, or do you think this trade war will will go on forever? Like, do you have any thoughts on this, or what investors should be watching for there?
Yeah, I mean, look, I hope it doesn't go on forever, Jesus. But I don't think we can't handle that. But funny enough, I'm going to pay as little attention to that as I possibly can. And I would probably encourage most investors to do the same, right? I think it's really important for us as investors who, again, are just focused on making money to focus on the things that we can control. And the reality is the only thing that we can actually control is our risk, and what our get out is, what our stop loss is, so on and so forth. And another thing that we can control, which is hard, but is our emotional reaction to unforeseen things, to risks, to headlines that we cannot control, right? And so that for me is where I spend my time focusing and investing my energy as much as possible. And I would encourage most investors to do the same, because I'm not saying this to take a victory lap on recent price action, because I don't think that there is anything necessarily to take a victory lap on. But if we make new all-time highs, which we did after the last podcast that we did together, I think we were trading like right around 110 or 112,000 the last time we recorded the show, and then we ripped to 126. And if we make new all-time highs again, which is my expectation, by the way, for Bitcoin specifically, and also for equities, but I'm talking right now specifically about Bitcoin, then, the cool, calm, and collectiveness that I've been able to exhibit over the past few weeks literally pays off. And I think one of the key lessons of this bull market, because this bull market has been entirely different than any other bull market that we've had in Bitcoin and crypto, right? It's been way more lucrative as an investor to allocate into the potential production of a higher low rather than the production of higher highs. So over the course of this bull market, repeatedly, we've seen new all-time highs get faded very quickly. And that's exactly what we saw. We got to 126 and we immediately faded that move, got down to 122, and then we had the capitulation on tariff day from 122 down to 107. So instead, it's our job as investors to recognize that pattern. This has been something I've been calling out for months now. And when we get that potential production of a higher low, that's where I now have the confidence to allocate into that. Look, I might be wrong. Maybe the bull market is over. We don't know. We can't control that. The only thing we can control is when we get out, or when we reduce our risk, or when we pause our DCAs. And so for me, I have those levels. I actually just outlined them this weekend for investors. And so check that report out 100%. But those are the only things that we can control. So what is Trump going to say? What is he going to tweet? How's the meeting with Xi Jinping going to go? No clue. Again, I'm not a political strategist. And even if I was, I'd be a way worse investor. So I just want to focus as much as I can on the astrology for men.
Caleb, that was inspirational, and I think a great place to end the show. I really appreciate you coming back on and giving us some clarity with these charts. Like I said, like your analysis is always really lucid, but it's non-traditional, and I think you look at this market in a way that's unique and really illuminating. So thanks for that. Where can we send people to find more of you and your work online?
Well, first of all, John, thank you. I really appreciate that. And, we were actually scheduled to do this later in November, I think November 5th. And you guys hit me up and said, hey, we got to do this now. So, I was really happy we made this happen. For investors, if you resonate with anything I said today, or if you hate what I said today, come let me know over on X at Caleb Franzen. That's where you'll be able to find me. I post a lot of real-time thoughts and analysis over on there. And then I'm also posting over on Substack, cubicanalytics.substack.com. You'll definitely love that as well.
Awesome. Yeah, I really enjoy going back and forth on X with you, trying to get everybody to calm down and stop freaking out. So keep fighting the good fight. And thanks for being on the show. And yeah, just like you said, like I wanted to bring you on because I need somebody to kind of settle the markets and to look at the charts with me. So yeah, thanks for being here. I hope we can have you back again really soon, Caleb.
Thanks for having me.
Awesome. And thank you all for joining us. I hope that you all learned something today. So until next time, stay safe, stay bullish, and we will see you all on the next episode of Milk Road Macro. Thanks, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.